What is up, my YouTube channel? So I was trying to think about how I was going to have this next conversation with you guys. Buy term and invest the difference. And I started going through Dave Ramsey's site. So infuriating. But I started going through his site and I figured I'm going to do it in a more tactful way. Remember to like, comment, share, subscribe to this channel. But what if I told you that term insurance, the only people that make money on term insurance are the insurance companies? There's no reason for you to buy term insurance. Zero. You're going to try to argue, well, it covers a specific window in time. Yeah, but you're wasting money in that specific window of time as well. And the reason why I feel so passionate about this is because it comes up quite often. Again, people chirping at me saying, all you're trying to do is sell life insurance. Yeah, I am. Because nobody really understands how life insurance really works. No one understands the tax treatments of it. No one understands how to properly structure it. Most insurance agents are lazy, ignorant, or greedy, if not all three. Most distribution channels that give insurance agents the opportunity are lazy, ignorant, and greedy. And when I know a bunch of those guys, they don't give good information. And there's a disservice of people getting good information out there. So we're going to use Ernst & Young as the benchmark. And you know, this has caused me to want to do more research to find out if PwC, Deloitte, KPMG, who else has this same mindset of Ernst & Young. And we're going to compare the buy term and invest the difference strategy. If I highlight this section right here of buy term and invest the difference, buy term and invest the difference right here. And I'm going off of a 25-year-old, 35-year-old, 45-year-old couple purchases annual renewable term insurance, which is the cheapest form of term insurance. And on Dave Ramsey's site, he's saying he recommends 15 to 20-year level term. Well, that's not good advice if you're really trying to buy term and invest the difference. But Ernst & Young is suggesting annual renewable term life insurance up until the age of 65, because you shouldn't need life insurance at the age of 65 and the buy term and invest the difference. And the rest of the money that's available goes towards stocks, bonds, and an investment, equity versus fixed income investment strategy. Okay. So that's what we're going to compare. And I'm going to first come over here and say, all right, I asked ChatGPT. I said in ChatGPT, historically, what percentage of term insurance policies ever written have paid a death claim? And the response was, historically, only a small percentage of term and life insurance policies ever pay out a death claim. Estimates suggest that less than 2% to 3% of all term insurance policies result in a death claim. Let me flip it around. 97 to 98% of all term insurance policies do not result in a death claim. The majority of these policies expire without a claim being filed because the policyholder either outlives the term or lapses the policy before the term ends. So Dave's recommending a 15 to 20 year term. This is saying less than 2% of all of those will ever pay a death claim. You're just wasting money. Buy term and invest the difference. Well, most people don't even invest the difference, right? They need a forced savings plan. But let's keep going. So let me show you the next page. And the next page says, okay, term life insurance death probability. And I was looking through here and it says right here, on average, a life insurance company, the issuer of the term insurance policy, may expect to pay a death claim on a term life insurance for about 1 out of every 100 insured people, or people insured. That's 1%. Who is term insurance good for? The life insurance, the person that needs the life insurance, or the life insurance company? So I kept going, right? Because you can't just trust two websites. What percentage of term and life insurance pays out? According to a Penn State study, 99% of all term policies never pay out a claim. Proponents say this is because most people let their policy lapse. But even if you keep your policy in force, you are still renting and just one payment away from having nothing to show for it. Okay, so then I'm like, what is this Penn Mutual study? Remember, like, comment, share, subscribe, because nobody is talking about the stuff the way we talk about. So here's the Penn Mutual study. Again, it was done in 1993, but I think that data is probably even more to our favor of this conversation today. The study found that 1% of all term insurance policies resulted in death claims, meaning that on average, only 1% of term policies will pay out a death benefit. They have a high lapse rate. The study determined that less than 10% of all life policies stayed in force during the entire initial term period. That initial term period is a 10-year term, 15-year term, 20-year term. Less than 10%, the study found, stayed in force during that entire period of time. Most term policies are either canceled or lapsed before the end of the term. Who is this good for? Okay, so let's keep going. Let's make sure we get our point home. Term insurance payout statistics. 99% of all term insurance policies never pay out a claim. This is due to most people letting their policies lapse. Okay, so why are they saying buy term and invest the difference? Because they are telling you permanent life insurance is bad. And I am telling you most permanent life insurance, the way it's structured, is structured incorrectly, because you have insurance agents that are lazy, ignorant, or greedy. Again, watch that video right here. You need to watch that lazy, ignorant, or greedy insurance agent video if you haven't seen it, because I can't even argue that fact, because most insurance agents are just trying to rip you off and get a commission. But there is a proper way to structure life insurance where you can get not only the death benefit, but you can get all of these characteristics right here: tax deferred growth, tax-free distributions, competitive rates of return, high contribution limits, additional benefits like long-term care, living benefits, accelerated benefits. You can use it as a collateral for bank loans. It's safe. There's no loss provisions, guaranteed loans. If you do borrow money from your policy, yes, it's your money. But if you do borrow money from your policy, unstructured loan payments, you can set the terms, the amount of time, how much you want to pay them back. You get liquidity and use and control of your money. The only thing that you don't get is deductible contributions. But there are 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 characteristics. You get 12 out of the 13, right? That's not bad. Okay, we can go with that. So what is this study that Ernst & Young put together? So it did 1,000 different scenarios using a Monte Carlo simulation and different probability of success. They ran it at 90% probability of success, 75% probability of success. And I went through this in my last video. You can watch that on how to the benefits of integrating life insurance products into your retirement plan. But the purpose of this video is talking about buy term and invest the difference. And we're focusing on the component of how do you take term insurance plus your investments, and is it good for you? Like Dave Ramsey says, is it the right thing to do? And really, the only way to justify this is to do math. This is math, not magic, right? And so here is this. While this is Ernst & Young saying this. This is not John saying this. This is Ernst & Young. While term life insurance can be an affordable and efficient product for pure life insurance coverage, but remember that pure life insurance coverage, 99% of it's not going to pay out. Only 1% of it has ever paid out. But that pure life insurance coverage over a certain period of time, Ernst & Young, Ernst & Young, find that permanent life insurance plus the investment strategies are more appropriate for long-term retirement investors because it provides more retirement income and more legacy. This result is also true when comparing permanent life insurance to just investments. Forget about the term insurance, but this video is about buy term and invest the difference. There are a couple reasons they go on to note. One, permanent life insurance tends to provide superior returns over fixed income in the long run scenarios due to the combined effect of the guaranteed growth of the cash value and the dividends if we're using a whole life policy. Look at this right here. I'm not making this up. Term life premiums do not boost long-term savings. Term life premiums do not boost long-term savings, instead acting as a drag on portfolio performance. Term life premiums are a drag on the portfolio performance. Ramsey doesn't talk about that. The second reason is that using permanent life insurance as a volatility buffer improves returns because the investor can take distributions in the form of loans from the permanent policies when the market's getting crushed, as opposed to if they don't have any permanent life insurance, then they got to realize those losses in those down years. Okay. So it goes on to say in the strategy right here, in the strategy, the comparison was this investment only strategy right here, right? The investment only of 50% equities, 50% fixed income. And term life insurance compared to the investment only strategy, was less income and less of a death benefit or legacy because you're not reinvesting. It has a drag on the entire portfolio. It's a true cost that's out the window. And we know that 99% of the term insurance policies that are written are not going to pay a death claim. So they're going to outlive that term, whether it's a 10, 15, 20-year term. So they paid for something that they got no benefit from, right? They didn't even get to live in the house when they were renting it. So term life plus investments was less income by 2%, 3%, 4%, depending on how much insurance they were purchasing. Not to mention, it is absolutely less income than the permanent life insurance by 3%, 5%, 6% less than permanent life insurance plus investments. But don't take my word for it. This is Ernst & Young. I'm not just trying to sell you life insurance because it's fun. This is a full contact sport. People need to be educated and properly positioned with how life insurance works. I have to undo all of this bad crap that you guys are hearing on the internet and the bad examples that your previous experience have taught you from buying life insurance. But it's unfortunate because, again, it is the only vehicle that has 12 of the 13 characteristics that you want from a savings account. Nothing else has that, right? Not even your 401k, your IRAs, your Roth IRAs, they don't have it, right? But I am trying to get you guys to understand that. And so that was for a 25-year-old couple. For a 35-year-old couple, I'm not even gonna go through the math. I'm gonna show you what this looks like. And by the way, I don't know if I did this on the first one. Yeah, here it is. This chart, pretty powerful chart. I didn't give it a whole lot of play last time, but this chart says the investment strategy alone of buy term and invest the difference is falling well short of the investment only strategy. So this is the investment only strategy right here. Back here is the buy term and invest the difference strategy. It's falling short from an income and it's falling short from a legacy perspective. That's for the 25-year-old couple at a 90% probability rate. Let's look at a 75% probability rate. So an even more aggressive strategy, falling even well short of the investment strategy. Less income, less legacy by just buying term and investing the difference. The buy term part is the crappiest part. You might as well not even buy insurance. If you're not gonna buy permanent life insurance, just don't buy it. Okay, here's for a 35-year-old couple. Here's the investment only strategy, and this is the buy term and invest the difference, less income, less legacy. For a 45-year-old couple, again, buy term and invest the difference. Maybe there's just one little aspect of it where it might make sense, but it really doesn't. Buy term and invest the difference. That's the solution Dave Ramsey's coming up with. And Ernst & Young is saying, their analysis shows that integrating life insurance products into the financial plan provides value to retirement investors. In summary, their analysis shows, Ernst & Young's analysis shows that integrating insurance products into a financial plan provides value to retirement investors. Penn State study said less than 1% or 1% of all term insurance policies resulted in a death claim. Make sure that you're doing your research. Watch this channel, reach out to me in the description section, schedule a 15-minute phone call with me. Let me do a policy review for you. Make sure you like, comment, share, subscribe. Let's keep this conversation going. If you're gonna try to come at me with a buy term and invest the difference rebuttal to this, you better have your math with you. I'll happily go back and forth with you, but you gotta have it. Look forward to talking to you in the next video. Be safe. Talk to you soon.